Hi guys, just to review an execution here quickly, and see I'm going long here, and this trade was able to capture 42 handles on 168 ticks on the latter portion of the New York morning session. It was a bad session. What we saw were signs of high resistance liquidity run conditions, and you can see now we are approaching the lunch hour macro, which starts from 11:30, and this is the time we are breaching the high of the first hour of trending. The range that we formed from 9:30 to 10:30, it was still trading inside that range for the whole hour. From 9:30 to 10:30, we had not managed to breach that, and now as we are approaching the lunch macro, we were just taking out the high there. We have annotated minor buy-side liquidity. So you can see I've marked the discount wick there of that candlestick, and you remember wicks are gaps. That's something that Michael has been teaching us. So ideally now what I don't want to see is bodies closing below that consequent encroachment level. And you can see my stop loss is below that, below the low of that wick, slightly wide, but it's always good to give price a chance to see whether it wants to revisit that consequent encroachment level. But if it closes below that, the back of my mind, I knew I would kill the trade. I wouldn't let it go to my stop. I would just kill the trade. So here I'm watching to see whether we'll form a fair value gap, because remember the first presented fair value gap that takes out that range high, 9:30 to 10:30. Ideally, it would be good to see it remain open, or a portion of it remain open, not entirely come and close it in. So I'm watching to see whether we'll form a fair value gap here, because you've seen we have a nice reaction up. We've had that displacement after we went long. So I'm watching to see. So I was aiming for that pre-session buy-side liquidity. So that is the high formed from 7 a.m. pre-market hours until 10. That high is still intact. It's not been traded to. So everybody who was short, so the bulk of the orders are, the stop loss orders are above that level. And you can see we came close to it and then dropped lower. And that to me is engineering of liquidity. So at this point now, as we are approaching the lunch macro, I wanted to see us go and take out that recession buy-side liquidity. So I'll annotate the fair value gap that we wanted to see. It has actually materialized. So if it's good, if it's strong, ideally it should not come back and overtake that fair value gap. So these orange lines are Fibonacci extensions. They are standard deviations of the first hour of trading, the range we form. So from the low to the high, so those are gradient levels, standard deviations, and I normally do 8 octants, then quadrants, then the consequent encroachment, and then the upper quadrant and the upper octants. If we get to them, I'll just keep populating them on the chart. But these are the two closest levels that I'm watching. And you can see the reason why I want to exit slightly above the pre-session buy-side liquidity is because in proximity to that we have that standard deviation, which is giving me the conviction that it's likely to displace and get to that. At the very minimum, it has to take out the precession highs, but above that, what is the easy target that it can reach for? And that standard deviation level to me is so close. That's why I put my take profit limit order slightly below it, so that if it gets there and reacts, at least it will afford me the feel to take me out. So I'm annotating that these are quadrant levels of that range that I mentioned. And you can see now we are retracing, we are pulling back into the BC, buy side imbalance, sell side inefficiency that we formed after taking out that minor buy side liquidity pool. But remember, old highs, when we overtake them, they can act as a discount arrays. Price may want to come back and touch them, but I wouldn't want to see a candlestick closing below that buy side liquidity level, that high to the left, because that would indicate that fair value gap being used as an inversion fair value gap to send us lower before we take out that precession buy side liquidity, which is not good. So ideally now, because we've just pulled back inside that fair value gap, the BC, I would like to see us displace and now go and attack that precession buy side liquidity. But you always have to give price a chance to see whether it wants to retest the consequent encroachment of that BC. The wicks can wick down and touch the low, but ideally I would like to see the bodies close above the consequent encroachment of that BC. That's how my code teaches us to read order flow, how to measure strength, the underlying strength in price. You can see the wicks have touched that consequent encroachment level. So I'm watching how this candlestick will close. I'm just reducing the risk here because now I don't want to see it go to the consequent encroachment of that discount wick. Not just the bodies, even the wicks now, I don't want to see them come there, because I already have the consequent encroachment of that BC in blue, the low, and you can see slightly below it we have the old high, the minor buy side liquidity. So those are three levels, so to speak, in my defense. So if it breaches those three levels, I don't want to see it go back all the way down to the consequent encroachment of that discount wick. I don't like how it has closed here, because you can see we've closed actually even below the low of that BC. This is not good. So that low, that old high now is my last line of defense. If we breach that, my stop loss would be next. So I'm watching to see whether this is one of those instances where price will color outside the lines, outside what you'd normally expect. So I'm moving my stop loss now at that low that we've just formed, because if we take out that low now, it's definitely gonna go lower. So, and you can see where we got that reaction, that retracement. It's at that standard deviation of that range that I was referring to the first hour of trading. So this is still algorithmic. That can actually be a small scalp from that level there into that fair value gap that we had formed. That can actually be a scalp. Would have sold there aiming for price to return to that fair value gap down there. Not so many handles, not so many ticks, but it's still a trade. And you can have so many of those within a day and cumulatively make a lot of handles or a lot of ticks. So now, since we've gone above that fair value gap in blue, I want us to see it used as a reclaimed bullish fair value gap now. Let me enlarge this, make it bolder. You can see where we stopped. The bodies were stopping there. So that's still good. Although it didn't book the way I would have wanted to see it book. So now any return to that BC, I don't want to see bodies closing inside it. It could wick inside, but just reject quickly and move higher. The short sellers now, when they saw that drop, they had a sigh of relief, thinking, now watch what will happen to them here. You can see that, you see that reaction, boom. They are now taken out. You can see the execution marks here. That's beautiful. So it's gone to the higher standard deviation, but my exit was on the lower one there, and that was the entry.